Heard you're on the city. Congrats. Where'd you end up? They're all black. That's good. Small, large, domestic born, like sometimes. Yeah. I thought you said that you wanted to. Yeah, it's awesome. Yeah.
You're chilling. I took it easy. My brother's
We need to work. We could either pick up. We can either do a small or do a private. Which is mostly probably private value.
M&A.
How's your break?
Good.
That's great. Finally got off the road. Very excited about you. Nice, congrats. Last Monday, because I went to can't keep the like prep like an interview and then get like no level.
Okay, folks. I actually asked for and got a new mic so that I don't have to put in my lapel. Hopefully this picks up my audio better, but let me know if you have issues, because first they were trying out this mic. Couple of things before we start. Same two questions as I said for the first few sessions I will keep re-asking. Anybody who's not part of a group yet in this class? Anybody not part of a group? Only one person, so two people. So 3, 4. Okay, so first thing to think about is, are you all part of the orphan list as well or no? If you're part of the orphan list, that's where to go. If not, get together as a group of 4 and see if you can have, if you have any common themes that you can kick in. So I'd say you have enough people here to form the group. Second, as I've been nagging you for the last week, I'd like you to pick a company. So how many of you have picked a company? As I said, pick a company, get a theme going, and don't overthink it. It doesn't have to be the perfect company. There is no perfect company. Every company has good things and bad things. And what your job is going to be to do is find out what they do well and what they do badly. So God's sakes, pick a company, because that's better than not picking a company. Okay, so today we're going to continue our talk of corporate governance. It's kind of a fuzzy word and a fuzzy set of words, and and what it means. But effectively, the question we're asking is, hey, given the end game for a business, and that's where we're moving, what is that end game and how do we get it accomplished? Last session, we ended the session by looking at the Disney board in 1997. Let me go back and kind of review what we found. We had an imperial CEO. What's an imperial CEO? A CEO basically makes decisions. The board then says, okay, okay, okay. And surprisingly large number of companies, that is really the state of corporate governance. You've got the equivalent of a Caesar sitting on the throne. And essentially the board of directors says, what would you like us to do? I mean, I think it sounds cynical, but I think it's realistic. Do you really think at JP Morgan that anybody but Jamie Dimon makes the final judgment? I mean, take the CEOs that are in the news that we think of as powerful CEOs, even good CEOs. We know essentially they are CEOs who generally do what they think is best for the company or best for themselves, as we'll see today. And the board of directors goes along. So I'm going to start by piling on Disney a little bit more. I mean, I pointed out why I thought the 1997 board was so flawed. It had a lot of insiders on it, which in 1997 was legal. It had, even the outsiders really had no particular role to play. But if you think in terms of the outsiders, there's one outsider I didn't mention. I talked about Owen E. Russell, didn't mention Sidney Poitier. Great actor, right? And in 1997, he actually made the list of top 10 directors. He's saying this is good. At least one person on this board made the top 10 list. He made the top 10 list of directors who didn't show up at meetings. So guess who's coming to dinner is guess who's not coming to the meeting today. This is the board of directors that really, somebody on the Zoom have a, this was the board of directors that was supposed to keep an eye on Michael Eisner. So as I said, I'm going to start by piling up. Because in 1997, there was probably one institutional investor who cared about corporate governance. It was an investment fund called CalPERS. Still around. Does anybody know what CalPERS does? It's a California public employee investment fund. It's one of the larger funds in the country. And in 1997, it was actually a fund that cared about corporate governance. It made a list of top 15 or top 20 companies that would target every year for change. And it also came up with a list of questions it asked of companies. So one of the questions they asked, they're pretty simple questions, common sense questions. Are the majority of directors on a board outsiders? Remember in 97, a lot of companies had insiders. Is the chairman of the board also the CEO? And finally, are the compensation and the audit committees, which are the committees that actually the most power in determining the future of a CEO, are they composed entirely of outsiders? And Disney was the only company that failed all three tests in 1997. Okay, since we're piling on, let's keep piling on. In 1997, Business Week ranked the worst boards at companies. And guess who's on top of the list? Disney. AT&T was trying really hard to get to the top of the list. They couldn't quite get there. So in 1997, the consensus was that the board of directors at Disney was not going to stop Michael Eisner. At this point, you might say, so what? There were a couple of things that Disney did in 1997, that, or the 1990s, that people looked at and said, why did they do that? How do you explain it? Why did the board not ask more questions? And I'll describe those couple of events because they were unfolded in the public domain. Michael Eisner, I said, was the CEO of Disney in 1997. He came to Disney in 1986 from a company called Paramount, at that time a movie company. And when he came in 1986, Paramount was the company doing well and Disney was doing badly. Disney hit a 15-year skid. Now, of course, we know the history of Disney is founded by Walt Disney. The Disneyland, made Snow White and a series of movies. He died in 1968, but his spirit ran Disney for about 17 years because people would always say, what would Walt Disney want us to do? And of course, nothing they did would have been things that Walt Disney wanted them to do. But from 1968 to 86, everything they tried pretty much crashed and burned. They didn't have a single animated movie become a super hit during the 70s. So in 86, Disney was desperate for a change. At that time, Michael Eisner was considered to be a rising star at Paramount. So they went to Michael Eisner and said, would you want to be CEO for a company? His first reaction was not really. And then they threw in enough money into the deal and he said yes. But he added a condition. He said, if I come to Disney, you've got to allow me to bring my personal assistant with me to Disney. You say, what's the big deal, personal assistant? Remember, these were the days before iPhones and calendars on your phone. Your personal assistant basically ran your life for you. They arranged your meetings, told you had a wife, told you where you lived, told you when her birthday was, or essentially personal assistants were critical for you operating smoothly. He said, and Disney said, fine. So he brought his personal assistant, a man called Jeffrey Katzenberg, to Disney with him. Jeffrey Katzenberg did not want to leave Paramount. He said, why do you want to go to that loser company? But no, that time Eisner said, you come along and I'll give you a division to run. And in true Eisner fashion, he picked the division at Disney that he thought was the biggest loser division. So you run this division. It was the animated movie division, which hadn't had a hit in 15 years. So Katzenberg comes in and he runs the animated movie division. And the rest, as they say, is history, because he, if you think about Little Mermaid and Lion King, he turned not just the division around, but was instrumental in turning Disney around as a company. In about 5 years, he took the division from nothing to accounting for a third of the profits of the company. Now, any business textbook, if you have somebody who's doing really well at a division, turns the division around, what's supposed to happen to that person? You push him up the ranks or push her up the ranks, give more responsibility. That thought never even crossed Michael Eisner's mind. You know what his reaction was? This guy is doing too well. He could become a threat to me. We have to get rid of him. So he went in front of the board and said, you need to fire Jeffrey Katzenberg. And if you're sitting on the board of directors at Disney, your first reaction is, why would you want to fire your most successful divisional head? You know what Eisner's reaction was? I don't like him. There's one small problem with firing, which is Eisner was so convinced that the animated movie division would never come back. They actually wrote into Katzenberg's contract a provision that entitled him to 5% of the profits of the movies he made at that division. Can you imagine getting paid every time the sea witch sings on Little Mermaid? Or Simba makes it out in The Lion King? You would never have to work a day, right? So the board said, but you've told him he can get 5% of the profits in The Little Mermaid and The Lion King. And Eisner said, don't pay him. So on what basis? I don't like him. Now, this is not a good contractual reason for refusing to pay somebody. I don't like him, just don't pay him. They fired Katzenberg, and of course he sued. And the court said, Mr. Eisner, what was your basis for not paying Mr. Katzenberg? And he said, I don't like him. And the court said, that's not a good enough reason. You got to pay him $150 million. So Disney paid Katzenberg $150 million, which he used as seed money to create a company. Does anybody know? Created DreamWorks. And therein lies the history of why, when you watch some DreamWorks movies, you see these barbs at Disney. How many of you watch the Shrek movies? Every Disney character is creating a perverse version of it, right? Sleeping Beauty was just addicted to pills. That's why she kept sleeping. Snow White hung out with 7 perverts, not dwarfs. Every Disney character, the dark side would come out in the Shrek movies. Now, first time I watched Shrek, why is there so much anger towards Disney? And then I read the history. I said, okay, now I understand. That was a Katzenberg incident. You'd think Disney would have learned after this, right? A couple of years later, Eisner goes in front of Disney and he says, you got to hire this guy called Michael Ovitz. You know what Michael Ovitz used to do before Disney hired him? He was one of the leading agents in Hollywood. Now, agents might be great at getting the best contracts for their clients, but they're not great at running businesses. That's not their job. So the board said, no, on what basis? He's a good guy. We'll bring him in. They bring him in. And 2 years later, Eisner decides he doesn't like Ovitz either. This is becoming a pattern. He goes in front of the board and says, got to get rid of him. Again, same process. They get rid of him, and Disney has to pay out another $100 million for him to go away. Each time one of these things happened, people would say, how come the board didn't stop Eisner? The answer was right in front of them. All they had to do was look at this board to see why this board would never have stopped Eisner. So here's the broader point. When you look at a board, the question you're asking is multi-layered. The first question, of course, is this board mostly independent, right? So you can go down the list. And in fact, I'll send you a link to a filing that companies have to make in the US called the 14-def. So if you're a US company, you have to reveal in that filing any potential conflicts of interest that lie with the directors on your board. And companies are actually very open about revealing everything because they know nobody reads these things. So they will tell you this person is my cousin, this person, and they'll be saying there are potential conflicts of interest. So take a shot at that. See if there are any conflicts of interest. You're saying, what if I am working with a company that's a non-US company? And I cannot find any information about potential conflicts of interest. Sometimes the absence of information is more revealing than anything you can find. I'm not going to be mysterious, but I'm going to take you back to a Sherlock Holmes book. I don't know which one it was, maybe The Hound of the Baskervilles. The Sherlock Holmes book. Now, Sherlock Holmes had this sidekick called Watson that he abused continuously. I don't know why Watson even hung around. But in this book, there's a murder in a house, and everybody in the house is a potential suspect. And nobody knows first whether it's somebody in the house or from outside the house. And Sherlock, as is usual, says, it was somebody in the house, Watson. It's simple. And Watson, of course, jumps into the phrase, why? And Holmes gives away the key clue: the dog did not bark. Now, this is supposed to be profound because it indicates that the dog knew the person, maybe hung out with the person, went to a bar, or whatever it was, that it was somebody that the dog already knew. You're saying, what's this got to do with information? When you cannot find out anything about the board of directors for your company, that tells you that corporate governance of this company is shot to heck. Getting information is often, very difficult with Asian and Latin American companies. So when you cannot find information, don't give up. That actually could become ammunition for, I can't find a thing about the board of directors of this company and the potential conflicts of interest. So I'm going to view that absence of information as potentially evidence that there are conflicts of interest. So start there by looking at the board, looking at how independent it is, perhaps finding information. Today, there are actually services that measure the quality of boards. It's a corporate governance score. Yahoo Finance, for instance, will tell you how your company ranks relative to other companies in the sector. So you can either come up with a numerical score or a ranking. Now, this is just an assessment by somebody. Service could be S&P, ISS. And what they're doing is they have a checkbox, basically. They go through the board and they look at things, and the audit committee independent. And based on it, they come up with a score. And I'll be quite honest, one of the things I have a problem with is these scores have become, essentially, they don't measure the effectiveness of boards. They just measure how well your boards met all the requirements to get a high score. It's the same problem I'm going to bring up with ESG scores. ESG scores don't measure goodness, they measure how well you can play the game that makes you look good. And corporate governance scores, for better or worse, will give you a score. Take it for what it's worth. It's a measure of how well these companies have learned to play the corporate governance game. So look at the board, look at the score, and then look for what I think is the best evidence on whether your board is effective. If your board is effective, what should it do at least some of the time? Disagree with top management, right? So if you find a board of directors that stops a company from doing an acquisition, that to me is much stronger evidence than any score about the company. So basically, you're going from independence to a score to any evidence you can find on effectiveness of the board. And I'll tell you, you're going to be frustrated when you look at your company's board because the first two are going to be easy. The third, you might have to give up and say, I don't know, but I'm going to make a guess. And that's all I'm asking of you, is to try to get a sense at least of, in this company, do you think the board is going to go along with management or push back? Go ahead.
Less likely to be debate and disagreement if the only representation from the company is the CEO.
But still, board votes in a sense, have to be made public. So if there is substantial disagreement on an acquisition, it will come out. So the spokespersons say we're all on the same page, but if there's disagreement at the board, it will come out as part of the, it will come out into the public, one way or the other. So it's very unlikely that if there's board disagreement that you will not be able to find out. Yes.
Like, I'm just thinking that like the story of like Steve Jobs or even like a guy like Elon Musk, right, who had so much of his own wealth in the company, isn't it against his best interest?
That's a good.
Board, like,
No, I don't know whether it's against his best interest. I mean, Bill Gates owned a big chunk of Microsoft. He didn't create a captive board. In fact, much as I dislike Microsoft as a company, and it comes from the fact that I'm an Apple lover, not because of anything Microsoft did. I mean, this is a company that, if you think in corporate governance terms, has been run exactly the way a founder-run company should be run if it wants to transition to becoming a great public company. Bill Gates, of course, when he started the company, was CEO. He didn't have to be pushed out, right? When he left in the late 90s and handed over the company to Steve Ballmer, he essentially said, I'm walking away. I'm not going to look over your shoulder. This is now your company to run. I can't even visualize Elon Musk doing that at Tesla, to be quite honest. And that is something you got to factor in when you think about investing in the company or analyzing the company. Good founders create transition plans. And since we're talking about good founders, you know who else kind of made an example of walking away from a company with one of the great companies of today? Amazon and Jeff Bezos, right? I mean, Jeff Bezos, essentially, he said, look, I've left Seattle. Of course, he seems to be on a yacht or pulling some bridge up in the Netherlands. So he's other things on his plate. But that is tough to do because this is your baby. You created this company. It's tough to let go. And the managers who hang on, the question you got to ask is, what is the transition going to look like? Because no matter what you think about Elon Musk, he's a great manager, it doesn't matter. He is human. He's going to get older. Then who is going to run the company after him? And that's really what you're not planning for as a founder when you're not creating an independent board and a way of transitioning power. So when you have this conflict of interest between what's good for managers and what's good for stockholders, if you have a captive board, and I'm going to say this without making any judgments about whether managers are good people or not, managers are going to put their interests first. Why? Because they're humans. Self-interest ultimately drives decision-making. You can tell me how, as much as you want, how much you care about the company, but if it becomes a choice between what's good for you and what's good for the company, and they're in conflict, you're going to pick your interests. I'm going to take two places or two scenarios where you see this unfold. The first is when you're the target company in a hostile acquisition. You're the management of the target company. I'm going to talk about how your interests are going to be often counter to the interests of the shareholders of the company and how your interests will often win out. So let's assume you're the managers of a target company in a hostile acquisition. What does the word hostile in the acquisition tell you about the acquisition? What's going to happen after the acquisition to you as managers? This is a very direct message, right? When there is a hostile acquisition, after it's done, you're going to lose your job. So let's make this real. You're the CEO of a company in a hostile acquisition. I'm a hostile acquirer, and I come in and offer 25% premium on your stock price. Now, this is a very tough argument to make to your shareholders that this is not good for them, right? Can you imagine if Activision had been the target of a hostile acquisition? Wasn't, but if it were going to your shareholders as the Activision management saying, don't sell to Microsoft. This is terrible for you. And you look at your stock price there, getting 25% more than the current price is terrible for me. Tell me more. So what you often see play out here is, I think, one of the most cynical processes in business, where the manager of the hostile the target of the hostile acquisition tries to convince their shareholders that they're doing things in the shareholders' best interest. So let me give you some examples of what managers in target companies in hostile acquisitions have done to fight off the acquisition. Because if you fight off the acquisition, you basically remain managed the company. The first is a process called greenmail. Anybody heard of greenmail? It's just like blackmail, just a lot more money and it's legal. So here's how it works. Let's pick a company. It's in the early 1980s. A lot of old-time oil companies were targeted in hostile acquisitions. Why? Because they were fat, rich, and very badly run. So one of the companies that got targeted was a company called Unical, Union Oil of California, old-time oil company. It's targeted by a man called T. Boone Pickens, legendary activist investor with a track record of having taken over companies and changed them. That actually matters, right? Because if you have a track record, you worry more. So you're going to be managers at Union Oil of California. I think you're Southern California based, maybe LA somewhere. You're managers at Union Oil. You've had a good decade, maybe a good 15 years. Why? Because you did nothing and the stock prices went up and the earnings went up because oil prices went up. In fact, you didn't even have to go into work, to be quite honest. What the heck were you doing in your LA office that was making your company more valuable? So you come down, getting ready for work. It's a Monday at 10 o'clock. Why 10 o'clock? You're not going to get in at 7:38. No, what's the point? You're sipping your coffee and you're reading the paper. At that time, there's no online news. Wall Street Journal, you see a headline. T. Boone Pickens targets Unical in a hostile acquisition bid. You're saying, why do you have to announce? In the US, once you get to 5% of the shares of a company, you have to announce your intentions as to what you plan to do with the company. You can say, look, I just want to hold the 5% as an investment. But if you plan to do a hostile acquisition, you have to say, this is what I plan to do. And T. Boone Pickens had called a press conference where he said, this is the worst managed oil company on the face of the earth. I'm targeting it. And my plan is right after the acquisition to replace the entire management. You spill your coffee, you jump into your car, you run into an executive meeting, everybody's there today. And your only singular objective, which is, how do we stop Boone Pickens from ruining our jobs? You come up with a great plan. It turns out that Boone Pickens had spent about $100 million buying the 5% that he's now got of your company. So he sent an emissary to Boone Pickens and he said, would you be willing to sell your shares back to us? His first reaction, of course not, but how about if we paid you $200 million for these shares? You see where the greenmail kicks in? You're paying $100 million premium, but if he agrees to it, you also have legal staff standing by and he has to sign what's called a standstill agreement. What's a normal problem with blackmail? You pay blackmail. I've never been blackmailed, so don't take this as a personal confession. But in general, you watch blackmail. Here's how it unfolds. You pay blackmail, but it doesn't end, right? Continues and continues. At least they've created a legal process in greenmail where once you've accepted the greenmail, you cannot buy shares in the company for the next 2 years, the next 5 years. That's what a standstill agreement is. So you pay $200 million. T. Boone Pickens agrees not to buy shares in Unical for the next 5 years, and he leaves. Now, how the heck you explain this at your next annual meeting? I don't know. I'm going to try. I'm going to be the management at Unical, and you're my shareholders. So I did this all for you. I wanted to make sure that some acquirer didn't pay a 20% premium on your shares, and I protected you against that premium being paid. And I used $200 million of the company's money. Remember, you didn't use personal money to fight this off. Use the company's money to protect your jobs. Let's be quite clear. The only group that's protected by paying greenmail is the management of the target company in a hostile acquisition. And they use shareholder money to buy that protection. It's greenmail. Let's move on to golden parachutes. It's amazing how much of the terminology in M&A is this strange blend of James Bond movies and medieval times. There are white knights and poison pills and shark repellents. So what the heck is this? Let's talk about golden parachutes. What's a golden parachute? You're the manager of a target company in a hostile acquisition. You're afraid of losing your jobs, right? Which is human nature. So here's what you do after you get targeted in a hostile acquisition. You run to your lawyers, personal lawyers as managers. You look at your management contracts and you put in a clause. And here's what the clause says. If there is a hostile acquisition at this company, I get paid $10 million. It's not fair changing the rules of the game after the game has been played, but that's effectively what you're doing in golden parachutes. It's protecting incumbent managers by having a payoff. You're saying, why does it matter to me as a shareholder of the company? Because somebody acquiring the company now has to set aside enough money to cover those golden parachutes. And that's going to come out of the premium that I paid you. When Revlon was targeted in hostile acquisitions in the late 80s, every management, the top management team went in and put in a clause, including the CEO, Michael Bergerac, who put in a $20 million clause into his contract saying, if there's a hostile acquisition in the company, I get paid $20 million. Again, the only group that golden parachutes protects are the managers who are protected by it. I can't think of a good economic reason you can give me as a shareholder why I should be okay with it. You're saying, why do shareholders agree to it? Usually for green mail and golden parachutes, the shareholders are not involved. It's the board of directors that essentially agrees to this. And if you looked at the board of directors, we talked about how they're rubber stamps. They're going along with what's good for managers. Since we're on hostile acquisitions, let's talk about poison pills. You're the target of a hostile acquisition. You want to stop the acquisition. Why? Because you want to keep your jobs. What you do is you introduce something into the mix that makes it unpalatable to the acquirer. I'll give you a couple of examples. There's a time when the FCC had this rule that you could not own more than one TV station in a particular location in the US. So if you owned a TV station in LA, you couldn't own a second TV station. So let's suppose I'm an entertainment company and I'm targeting you as another entertainment company or an acquisition. I own a TV station in LA, you don't, you're the target company. So you know what you do right after I target you? You go buy a TV station in LA, then you run to the FCC and say, you can't let this acquisition go through. It's against the law. I'll give you another example, and this is going to sound convoluted, but I'll give you, it's happening right now at a company that many of you might be familiar with. It's called a flip over rights plan. To kind of understand this, you first have to understand how rights issues work at a company. Let's say you're all shareholders in my company. Typically, the way rights issues work, let's say the stock price is $10, I give you the right to buy an additional share at $5 per share. You're saying, what does it accomplish? If I want to raise capital, each of you will exercise that right because it's in your best interest to do it. You can even sell the right if you don't want more shares. But I collect capital. It's a very low cost way of raising equity. In fact, one of my pushbacks against US companies, they don't use rights offerings enough. So typical rights offering is a standard way of raising capital. In a flip over rights offering, here's what you get. You each are shareholders of the company, the stock price is $10. I give you the right to buy an additional share at $100 per share. What's your first reaction? That's useless. Why are you giving me this right? As long as I run the company. But the minute there's a hostile acquisition, that exercise price drops from $100 to $1 per share. You see what I've done? As long as I run the company, the rights offering is completely benign. It can't be used. The minute somebody tries to do a hostile acquisition of the company, these rights all blow up on them. And they now, they think they get to 51%, but now the rights kick in and they have to buy even more shares in the market. It makes it much more difficult to get an acquisition done. So if you've been reading the financial news, who's using a poison pill right now to try to stop a hostile acquisition? You haven't been reading the financial news, right? Yes. Kohls is using it right now. Kohls, for those of you not familiar with malls, because you drive into a mall, you'll see it. is a retail/department store. And it's been targeted by an activist investor who's acquired 8% of the stock at 10%. It's kind of a no-name activist. I'd never heard of them before. But Kohls has now introduced a rights plan. And essentially the rights plan, they've actually set it up in such a way that it's triggered by the, so if there's no hostile acquisition, you don't get a right at all. The minute there's a hostile acquisition, the rights offering will be triggered with a discount of 50% on the current stock price, which means if you try to take over Kohls now, you got to factor in that the number of shares outstanding is going to be twice as high as what you thought it was, which means you got to buy more shares to get to 51%. Again, flip over rights offerings, you think about who's benefiting from it. It's primarily the managers at Kohls. And they've, of course, framed it as we're doing this for the shareholders. Because these are bad guys. They're going to do bad things to Kohls. Well, the bad things to Kohls have been done by you for a long time, but we'll kind of forget that. But the argument is we're doing this for the benefit of shareholders. And looking behind the curtain, we can agree or disagree with what the activist investor is suggesting. But if you truly believe that what you're doing is right and what the activist investor is doing is wrong, fight them on the facts. They say, this is not the way to run a retailer. We would do this instead. Let's talk about shark repellents. If you think about corporate shareholding as a democracy, winning an election requires what percentage? 51%, right? And when you look at most corporate charters, when they're initially set up, you get to 51%, you control the company. You get to vote on the board of directors. Here's what shark repellents do. They change the rules of the game. Again, I'll use a very specific example. In the early 1990s, NCR, National Cash Register, which its history goes back a long time to when cash registers were a big business, was targeted by AT&T in an acquisition. NCR went in and changed its corporate charter. This is in the Constitution of the United States. It's easy to change your corporate charter. You do require shareholder approval, and they did get it. And this is why it's a lesser sin. At least the shareholders get a say in it. And what NCR did was it created a rule that you needed 2/3 of the shares to control the company. And of course, they framed it, and we're going to use this to negotiate the best possible price in a hostile acquisition. So there is a potential upside. But by changing the rules of the game, again, you've made incumbent managers more protected. In fact, just as an aside, NCR's supermajority clause, which is what it was called, was created by a man called Marty Lipton. For those of you, I think, anybody from the law school here? No, Marty Lipton, legendary lawyer. In fact, he was incumbent manager's best friend. He was responsible for creating a bunch of shark repellents at companies, which could pass legal muster and stop acquisitions from happening. His basis was managers are good people. They run companies well. And hostile acquirers is just a pain in the neck that ruined this process. We'll come back and address whether he has good basis for that or not. But that was his rationale. So when you look at a hostile acquisition, the Kohls might be a good one to follow through the semester, see how it plays out. You're going to see this game play out. And the question you got to ask yourself is, who's benefiting from these actions? And what does it tell you about corporate governance at the company? Any questions about hostile acquisitions and the unfolding? Go ahead. Yeah. Whatever you can get away with, right? I mean, why didn't, if you think of Bergerac, why didn't he put in $2 billion? Because at that time, that would have been beyond the realm of what would have been accepted. You got to make it high enough that you get rich, but not so high that it looks like you're stealing the entire company with the shareholders. There's a cynical way of looking at it, but there's no upper limit. So if you have a $2 trillion company, and God only knows how big you can make your escape clause, because that's what it is. Let's now talk about the other place where you see manager and interest play out. I've talked about the target company in an acquisition a great deal so far. But let's talk about acquiring companies. Friendly or hostile takeovers. when they do the takeovers. Okay? When you look at a merger, take Microsoft and Activision or any other big merger, there are two companies involved. There's the target company and the acquiring company. And usually our attention is focused on the target company. I mentioned this in the last session as well. But take a look at what happens to the stock price of the acquiring company. Because what you get is an instantaneous response of what markets think about, no matter what rationale you give, about whether you're paying too much or too little. And I mentioned that in about half of all acquisitions, the acquiring company's stock price drops at the time that they announce the acquisition. The target companies always goes up, but the acquiring companies drops. Why? Because the market, at least at the point of the announcement, is making a judgment that you're paying too much. If you ask managers at these acquiring companies to explain this, you say, why did your stock price drop 3%? Their response is pretty standard. They say, well, it's because stockholders don't get to see what we see. We have more information. We've looked at the numbers, we've seen the synergy, and they're not as informed as we are, which is technically true, right? Managers do know more about the acquisition than stockholders do. But there's a very interesting set of statistics that suggests that markets at the time of the announcement actually make a better assessment of whether an acquisition is eventually going to play out than managers are. Here are the two pieces of evidence. First is if you track acquisitions 5 or 10 years past the deal, right? So you've given them the managers enough time to deliver on the synergy and control on all that neat stuff they talk about. It turns out that about 80% of mergers deliver no synergy benefits at all. So all the synergy talk, nothing shows up. That almost half of all acquisitions are reversed within 10 years of the original deal, which is the ultimate admission it didn't work out. So here we have two groups of people making assessments at the time of the acquisition. The manager of the acquiring company, what percentage of them tell you the deal will work out? 100%. Have you ever seen the CEO of an acquiring company come out and say, I don't think this deal will work, but we're going to do it anyway? So managers are saying 100% of the deals will work out. And markets are saying that about half of all these deals might work out. And in hindsight, if you look at the best predictor of eventual success or failure in a movie, it's that, not a movie, but in a merger, is what the markets do at the time of the announcement. It's not perfect, but what do markets bring that managers don't? No bias, right? Managers, by definition, are going to be biased about deals they've nursed through. That bias becomes so powerful that it overwhelms whatever information advantage they might have had, companies. So let me give you a very specific example of how this plays out in a merger. Let me take you back to 1987. In fact, let me take you back all the way to the 60s. A company called Eastman Kodak rose to the ranks. In fact, the early 70s were one of the what are called Nifty 50 stocks, high growth, huge premium stocks. So think of this as the equivalent of what you see with young tech companies today. The early 70s, Eastman Kodak was a star company. It sold cameras, it was growing like crazy. And in fact, even in 1987, it was viewed as a really well-managed company, well-regarded by markets. And I'm going to tell you on one day, the entire perception of Eastman Kodak changed. You say, what can happen in one day? Let me take you back to the late 1987. Eastman Kodak enters into a bidding war with a Swiss pharmaceutical company called Hoffmann La Roche for a drug company called Sterling Drugs. Now, let me pause. Eastman Kodak at that time was a camera company, film company. It's buying a pharmaceutical company. Now, there is no synergy rationale you can give me, right? Unless you figured out a way to deliver drugs through a camera lens. There's really nothing. So you're saying, why would Eastman Kodak buy Sterling Drugs? They probably listen to a corporate strategist. Have you seen these BCG matrices? Growth and in fact, they're cash cows and dogs and pigs and all kinds of farmyard animals wandering around. And what you're supposed to do is go for the stars, right? Stars have high growth, and high margins. Eastman Kodak by 1987 was looking like a cash cow. Its camera business was good, but wasn't growing anymore. The Japanese had taken over the growth. And the stars in 1987 were drug companies, pharmaceutical companies, huge margins, high growth. So it's almost like a strategist comes and says, you got to buy a star. And Eastman Kodak listened. So they targeted Sterling Drugs. Sterling Drugs, which had been trading at about $40 per share, Eastman Kodak starts bidding. Obviously, you have to pay more than 40. They get into a bidding war. They keep pushing up the price. At about $72 per share, Hoffman drops out. But Eastman Kodak didn't seem to notice. It's like you're on eBay. You're bidding against somebody, the other person drops out. You keep bidding against yourself. I think that's crazy. They were so used to pushing up the price. Eventually at $89.50, Eastman Kodak won the bidding war. If you open up the Wall Street Journal on that day, you know what you'd have seen? Eastman Kodak wins bidding war. This is good, right? Winning. Well, let's hope they keep the winning to a minimum, because on the day they won, here's what happened to Eastman Kodak's stock price. They lost about $2.2 billion in collective market value in one day. They lost 10% of their market value in one day. So what's the market saying? You paid too much. Now, this might be pure coincidence, but the premium that they paid over and above what used to be the market price before the acquisition started was about $2.1 billion. Looks awfully lot like a zero-sum game, right? Because when you overpay for a company, guess where that money comes from? It's not magical. You're not printing it off. It's coming from your shareholders' worth. So at least on the day this acquisition happened, the market was saying, this makes no sense. This premium is way too much. You're saying, what's the extra 100 million for? Probably banking fees. So if you'd interviewed Eastman Kodak's managers in that day, they'd have said, they, the shareholders, don't see what we see. Okay, so let's see what happened in the years after. Sterling Drugs is acquired by Eastman Kodak. It becomes its own division. So you could track what it was doing standalone. And it did absolutely nothing. This was a period where pharmaceutical companies were growing 15% a year. The margins were improving. Sterling Drugs has stayed stuck in neutral. So if there's benefit showing up, it's not showing up in the numbers. And in fact, things got so bad that in August of '93, the New York Times printed a rumor that Eastman Kodak was thinking of divesting itself of Sterling Drugs. When the New York Times rumor came out, the CEO of Sterling, which was the division of Eastman Kodak, said, this is massive speculation. It's an absolute lie. Remember the old saying, never believe on anything until it's officially denied? It's been officially denied, but it turns out the rumor was right. Because in the months after, Eastman Kodak sold off Sterling Drugs for about, it's a combination of different sales, about $3 billion. Let me take you back to what they originally paid. They paid $5.1 billion for Sterling Drugs. And 5 years later, you're getting back about $3.5 billion. You don't need to do any internal rate of return calculations to know that if you spend $5 billion in year one and get back $3 billion in year 5, this is not a good deal. I am convinced that Eastman Kodak's decline into nothingness, which is what, because right now, the only valuable thing left at Eastman Kodak is its name. I'm convinced that its decline started on that day where they overpaid. I mean, I know this sounds extreme, but I'll talk about some of the stocks in my portfolio, but I have one rule. The minute one of the companies in my portfolio does a big acquisition, I'm out of the door. Because a history of big deals is lots of people benefit, but the one group that historically has not benefited is shareholders in that company. I'm a Microsoft shareholder. I did not sell after the acquisition. You heard my defenses. $70 billion sounds like a lot of money. But when you're a $2.5 trillion company buying a $70 billion, this is not a big deal. To Microsoft, this is a small deal. It could still get them into trouble. But thank God they didn't go buy Tesla. That would have been a big deal, right? So when you look at big deals, especially as for, read what managers say, because you're going to get the PR, you're going to get the spin. But then be cynical and ask yourself, who's benefiting here? Is there truth to what's being said? Are they being specific? Don't let them use buzzwords to get away with it, because they are going to try, right? Synergy, strategic considerations, ESG, whatever they want to throw into the mix. Look past the statements and look at what the market is saying with its effect on the stock price. Yes. Well, if you truly want to do it, what do you have to do? You got to get your hands dirty. You got to value the target company. You got to value synergy. If you get a chance, you can go back and look at, remember when InBev, largest brewer in the world, bought SAB Miller, the second largest brewer? And at the time that was done, InBev was run by a Brazilian group called 3G Capital, a group that's regarded as extraordinarily shrewd in its deal making. So when they announced the deal, my presumption was there must be something here. So I took their words as my starting point, but then I started digging. Where's the synergy? How much would I value it? It's still your assessment. But if you truly want to answer that question, you have to dig through and get past buzzwords and actually put some numbers on synergy and strategic considerations and make your final assessment. Yes?
I'm wondering if companies are getting better at acquisitions now that we know this information.
No, you know why? The process is screwed up. There are 4 people, especially in a friendly merger, in a room. I'll tell you who the 4 people are. And you tell me whether any of them has the incentive to ask questions that will question the deal. You have the acquiring company's CEO or management group. You have the target company's CEO or management rep. You got the acquiring company's banker. You got the target company's banker. It's a friendly merger. Who wants the deal not to go through? Let's ask the banker. As a banker, you want the deal to go through? It's an easy question. Of course, right? You're the acquiring company CEO. It's not your money, it's other people's money. And this deal will make your company bigger. Who knows what other, maybe you want to build an empire. And the target company CEO says, look, I'm getting a 30% premium. And often when they own shares in the company, they get the premium as well. The process is screwed up because nobody in that room has the incentive to ask tough questions. We can talk about what we need to do to fix the process, but I wish M&A classes spent more time on how do we fix the process. They keep looking at deals, acting as if the process is objective. It's not. And as long as the process is not objective, this disease is not going to stop. It's just going to grow. In fact, you know what we're finding? Until about 20 years ago, this disease hit mostly US companies because they were the acquirers. And emerging market companies were target companies, and they benefited from this overpayment. And of course, over the last 20 years, many emerging market companies have become big enough that they can now become the acquirers. So if you look at Tata Steel or Tata Chemicals, or many of the Indian companies going on, studies actually show that the same disease is showing up there as well, which is these companies routinely overpay. And when something persists and doesn't go away, the problem has to be in the process. Because they can see all the studies, right? Rationally saying we shouldn't do acquisitions, but I promise you acquisitions are not going to stop because there's an ecosystem living off acquisitions, consultants, bankers. They're like drug dealers. I'll be quite honest. In fact, when I do a session on acquisitions called Acquirers Anonymous, 7 Steps to Sobriety. And here's why I call it that. When a company starts growing through acquisitions, it's like a disease. You cannot go back to taking projects. It's too much work. So much more glamorous doing big deals. It isn't. So if it's an addiction, somebody's got to be feeding the addiction, right? And that's where the bankers and consultants come in. They will give you the intellectual framework, the consultants will, for doing what you want to do. And the bankers will cover you with the numbers. They'll sign off the fairness opinion, the most useless document known in the history of acquisitions. and you're fully covered. You can make the worst deal on the face of the earth. But you can say, look, I followed these consultants from Harvard. Let's pick on Harvard while we're here. These bankers told me this was going to be a good deal. So here's what I'd like you to do, because so much that is bad in companies comes from where the power lies. That I want you to start with something that's non-financial. Tell me where the power lies in your company. So let's think about the choices. Maybe you're one of those very unusual companies where where shareholders actually are the ones calling the shots. But you're very quickly going to see that in many companies, not all shareholders are created equal. You're a shareholder in Facebook. I used to be until they changed the name. That's another signal for me. No company in history has ever changed its name because it makes them feel good or for good reasons. You change your name, and human beings say, why do you change your name? Because you committed a crime. Everybody knows who you are. Let's change my name. So I sold my shares when they became Meta. But I was a shareholder in Facebook for a while. I started when I was after the Cambridge Analytica scandal, and I sold when they changed their name. But I was a realist. I knew that at Facebook I was a shareholder, but there was one very special shareholder who essentially ran the company. And that, of course, is Mark Zuckerberg. You're saying, what's wrong? He's the founder. That didn't bother me that he was the founder. The fact that he fixed the system so that he could control the firm, even though he owned only 20% of the shares. And how did he fix the system? What did Facebook do that gives Mark Zuckerberg 57% of the voting rights with 20% of the shares? He actually created two classes of shares. This used to be non-existent until this century in the US. In the US, to be listed on the New York Stock Exchange, you could have had only one class of shares. I think Ford might have been grandfathered in, but when the rule was passed, but for a long time in the US, if you become a public company, you had one class of shares. Microsoft, Apple, one class of shares. Then Google screwed up the system. First, they said, we don't care whether we're on the New York Stock Exchange. What's the big deal? We'll be on the NASDAQ. And NASDAQ, of course, was so greedy to have companies listed, so you can do whatever you want. And Google, of course, when they went public, created two classes of shares. And when it happened, I thought portfolio managers would push back, right? Because you're giving up power. And they just said, you know what, Google's well run, who cares? And I'll come back and address that reasoning for why it's okay to have voting and non-voting shares. It's a benevolent dictator. So let's let him have the power. You know what tends to happen to benevolent dictators after they become dictators for a while? They turn malevolent, and then God help you don't have the power still. But inside shareholders then get to make the big decisions. And this is the point you made, is won't inside shareholders care about the share price? They do, but they also care about other things, right? In fact, we'll talk about risk and how when you're an investor in a company, the way you think about risk is risk in a portfolio. Because when I owned Facebook, it wasn't the only company in my portfolio. I had to think about what will this do to my portfolio? So when I looked at Facebook making decisions, I judged it through that perspective. But when Mark Zuckerberg looks at decisions, remember, he's not just a shareholder in Facebook, he gets a bulk of his wealth from Facebook. Not everything that's good for inside shareholders is good for outside shareholders. So in some companies, you might decide it's shareholders of the power, but not all shareholders, but a subgroup of shareholders, a founding family, a founder, somebody who's a CEO with a big chunk of shares. There are some companies where managers run even though they don't own any shares. Why? Because these are companies that have been around a long time. The shareholding is splintered. Nobody owns enough shares to care. Notice nobody targets Con Ed. It's so boring. What are you going to do with it anyway, right? The people who own shares in Con Ed tend to be big institutional investors who would basically sell and move on if they don't like the shares. The managers at Con Ed own basically their stakes in the company at times. But because nobody has an incentive to get together and challenge them, those managers might be the power center in the companies. You've got inside shareholders, outside shareholders, managers. Let's look at some unconventional places where power can lie. There are some publicly traded companies where the government of the country that the company is in is essentially still going to be controlling the company after it goes public. I'll tell you the sad but true story of a company called Petrobras. And I'm going to talk about Vale, another Brazilian company. And I'm going to talk about how, if you're the CEO of the company, the person, one person that you got to keep happy is the Minister of Finance in Brasilia. And we'll talk about why, even though these are publicly traded companies. In India, there is, we're on the verge of a company called Life Insurance Company of India, LIC, going public. It's a company for a long time that was a monopoly insurance company in India. If you wanted to buy insurance in India, that was often the only place to go buy insurance. It's been government owned for all of its existence. It's going to go public. Why? Because the government needs money. But the government also values control. So you know what governments really want to do when they privatize a company? They want to be able to sell off 80% of the shares, but still run the company as if it's their company. We'll talk about how the game gets cooked when this happens. But really the power there is not the shareholders, it's not the lenders, it's the government. There are a few companies where employees run the company. Why? Because a pension fund might have ended up becoming the largest shareholders in the company. This is true for a few European companies, where it's the employees running the company and the power lies with them. And finally, there are a few companies where lenders are running the company. Why? Not by choice. Under what conditions do lenders end up running a company? When you have trouble making your payments, no bank ever wants to be running companies. That's a sign of bad health, not good health for the bank, is when you're running a lot of companies. There are some companies where the lenders call the shots. So you're saying, that's what I want you to ask of your company. And I'm going to give you some one way at least you can try to address this question. What are the Bloomberg terminals in the building now? Any of you know? You don't even know what a Bloomberg terminal is.
I think we have it online right now.
You have it online?
Yeah.
I tried yesterday. It wouldn't let me get in. I hope it's still online. If it's online, that's great. What I want you to do is log into the, I'll send you the instructions if it's still online. Go to Bloomberg terminal. You can pick your company and you can pull up, it's all public information. So you can get the same information even if you have no access to a Bloomberg terminal. One of the things I'd like you to pull up is a page called the HDS page. HDS tells you who the largest shareholders in your company are. It runs pages and pages. Just print out the first page. It'll tell you the top 17 shareholders in your company. I'm going to take 4 companies from my lab experiments and show you how I would read these pages to get a sense of where the power lies. That's going to be my end. So the first page I'm going to show you is Disney in 2003. I'll show you what Disney in 2009 looked like. Very different, but this was Disney in 2003. Top 17 shareholders. Don't try to read the names. Just look at the third column. It says 13F for 16 of the 17. A 13F is a filing made by a mutual fund or an institutional investor with the SEC. So 16 of the top 17 shareholders at Disney are mutual funds or institutional investors. If you were a Disney shareholder in 2003 and you looked at the list, you know what your reaction should be? Your stomach should drop. There's not a single name on that list that's going to stay and fight managers. They don't like the way Disney's run. They're just going to sell the shares and move on. There's one individual on the list, Roy Disney. And look at how much of the company actually owns, 0.66%. And in 2003, there's a story I'll complete later, he was actually working at Disney as the head of one of its divisions. You know what my sense of Disney is in 2003? This is a company run by the managers, for the managers, of the managers. There's really no power outside that's going to come in and stop them from doing what they're doing. I'll give you some hope later as to what happened after 2003 at Disney, but that's what I get by looking at the top 17 shareholders. About 70% of the companies you will look at, you're going to get to this endpoint, which is this is a company run by the managers. 90% of European companies are companies where shareholders are distant memory, right? They went public 100 years ago. It's the managers of the company who are calling the shots. And by itself, there's nothing good or bad about that. Right? Managers could be really good or really bad, but the managers hold the power in these companies. Let's move to my second company. Vale, the Brazilian mining company. It turns out that Vale has a very strange share structure. Not share now that I've talked about Facebook, but it has two classes of shares. Voting shares, 3,172 million, and non-voting shares, which are 1,933 million. Let's start with the cynical question. Let's say you want to buy shares in Vale. You get on Schwab online, or you get on some Brazilian online brokerage, and you buy shares. Which class do you think you're going to get the shares in as an investor in the company? Probably the non-voting. Start with that presumption. When you see two classes of shares, the shares you will tend to be able to get easily will be the non-voting shares. And it's strange. It's almost Orwellian in the naming. You know what the non-voting shares in Brazil are called? They're called preferred shares. I've always wondered what's so preferred about me that you don't let me to vote. But I guess I must be special. I get a little dividend up front. So you're special, you're preferred. The voting shares in Vale are held by about 4 or 5 big entities, one of which is BND, that's the Brazilian National Bank, which is controlled, of course, by the Brazilian government. So if you're the CEO of Vale, you don't have to keep shareholders happy. You don't have to keep bondholders happy. You have to keep the Brazilian government happy. Now, by itself, that might mean nothing at the moment, but you're going to see this play out when you see actions taken by the company. In fact, Vale, because the rules are already tilted so much in favor of the government, decided it wasn't enough. And the Brazilian government actually has what's called a golden share. Golden shares were actually concocted or created in the 1980s when UK companies privatized. You know what a golden share gives you the right to do? It gives you veto power as a government. What does veto power mean? If Vale decides it wants to take a big project in Canada or do a big acquisition, the government gets a vote, and it's the only vote that matters. You can get a 9-0 on the board, but the government says no, it's done. As we look at Vale, I want you to keep this in mind because there are some things Vale does which you say, that makes no sense. But you're thinking like a shareholder, thinking in terms of what's in the best interest of the company, and you got to reframe it in terms of who's running the company and what do they want the company to do. I'll send you a link after this session to a post I did on Petrobras in 2014. Just to give you some background, Petrobras used to be a $200 billion company in 2010. And it managed to become a $50 billion company 5 years later. Now, this takes a lot of doing to wipe out $150 billion. So in this post, I looked at what Petrobras did. And remember in corporate finance, we talked about the first principles. If you wrote a perverse version of the first principles, which is invest in projects only if they have a return lower than your hurdle rate. Find a funding mix that doesn't work for you and pay out what you don't have as dividends. Petrobras would be a classic case study. But here's what happened. In the later years, between 2008 and 2009, somebody up there in Brasilia, a politician said, Petrobras, I want you to become the biggest oil company in the world. So if you're the CEO, how you judge? How many barrels of oil are you going to get out? How big are your reserves? And that's exactly what drove Petrobras into the ditch. It makes complete sense once you think about who it is that's calling the shots and who they're accountable to. For some of your companies, when you look deeper, you're going to say, this is a company that looks like a public company, but the shots are being called by the government. I'll give you a very simple case of how this is going to play out. If you're a publicly traded company, you want to maximize wealth. And let's say you're a board of directors and you're talking about tax strategies. Let me ask you a question. Is your objective to minimize taxes? Of course, I'm not breaking any laws, subject to the tax laws, or to maximize taxes paid? It's an easy one. Let's go along. Don't worry about the moral judgments I'm passing on you as you do this. But if you're a company, you want to pay the least taxes you can, given the tax laws, right? But let's say that one of the directors is a government director. Who do the taxes go to that you pay? They go, this is a revenue stream, right? So when you talk about minimizing taxes, the guy puts up his hand and says, I don't think that's such a great idea. I think you should be maximizing taxes paid to the government. You know, the effective tax rates of European companies, and there are quite a few European companies where the government still remains kind of the power behind the throne, pay effective tax rates about 10 to 12% higher than the sectors they're in. This might be pure coincidence, but it reflects again what happens when the focus or the power lies with the government. Let's move on. Yeah, go ahead.
That's not necessarily a bad thing. The Europeans might have like a.
That's fine. I mean, if you talk of the perspective of society, you're saying that's the best, you know, that's good for society. So again, I'm not saying that's not, as society, you might decide that government should be running everything. Let's face it. The power behind the throne for every Chinese company of any size is in Beijing. And we've discovered this with Chinese tech companies in the last 2 years, right? We thought Alibaba and Tencent and JD were so big and so powerful and so successful that they could chart their own course. And the Chinese government said, not so fast. Again, I'm not saying this is a good thing or a bad thing. I'm saying being aware of where the power lies will let you at least understand why companies do what they do. Let's take a look at Tata Motors. Again, I printed out the HTS page. Very interesting, a lot of Tata companies on that page. And this is a feature, not a bug, with companies which happen to be family group companies. What I mean by feature, not a bug, is many of the largest shareholders in this company will happen to be other companies in the group. And this is not a conspiracy to make your life difficult. It's a reflection of their history. Until about 30 or 40 years ago, all of the Tata companies were privately owned by the family. So let's say it's 1967. Tata Steel wants to build a new plant, but doesn't have the money. Tata Motors had a really good year and there's a lot of money. So what does the family do? It takes the money out of Tata Motors, it's perfectly legal. They own 100% of both companies. It puts it to Tata Steel, and the accounting then has to work. So what they do is they give a piece of Tata Steel to Tata Motors. So the longer you've been around as a family group company, the more you're going to accumulate these other companies in the group. In fact, the Tata company with the least holdings in other Tata companies is Tata Consulting Services, which happens to be the most lucrative, the most valuable of the company, but is also the youngest of the companies. It hasn't had a chance to acquire these cross-holdings. This creates nightmares in valuation. So in my valuation class, I talk about what I call the black hole of valuations when you have cross-holdings. But from a corporate governance standpoint, it creates a special set of issues. And here's why. Let's say that you're a stockholder in Tata Motors. Remember, you own shares in one of the companies, right? So you want the company to do what's best for you. But you know that almost all of the Tata companies share one building in New York called Mumbai House. And each floor is a different Tata company. So Tata Motors, Tata Steel. And the very top floor used to sit somebody with the name Tata, somebody with Tata in their name, called Tata Sons, basically. Do you think any decision on any floor of any consequence is getting made without going to the top floor and saying, is this okay? Again, it's not a good thing or a bad thing. The family group is going to think about what's best for the group. And sometimes they're going to make companies do things that are not in the best interest of the company, which is terrible for you because it's not fair, because it benefits some other company. As we look at Tata Motors, keep that in mind. We say, why would they do that? The answer is not in the company, it's in the group. Now, of course, when I did this about 10 years ago in India, the reaction I got, but this is the Tata Group. For those of you not familiar with Indian family groups, and most of you are not, the Tata Group is not just one of the oldest family groups in India, it's considered to be one of the most trustable, most credible groups. But it's a Tata Group. They would never take advantage of their shareholders. They would never let family interests come over shareholder interests. And my reaction was, really? Are they saints? In fact, if you look at the Tata Group, it's actually, it's a very, very convoluted setup. Almost every family group, there are these structures which are created to keep the power going. There's one outside family group that the Tatas let in. They regret it now. About 50, 60 years ago. That family has the last name Mistry. And in fact, Cyrus Mistry, who's part of that family, was allowed to become CEO of the Tata Group about 10 years ago. And was, at that time, people said, look, the Tata Group is allowing somebody who's not part of the Tata family to become CEO. If the story had ended there, happy ending. But if you want to go read the full story, you can in the press. But about 5 or 6 years ago, Cyrus Mistry was pushed out by the Tata family. And of course, they framed it as the best interest of the group. That fight is still going on legally. But my point is, no matter how benevolent a family, when you have a family group of companies, the family's interests eventually will win out. Which brings me to Baidu. Baidu, at the time that I looked at, was already a $100 billion company. But I told you, Baidu is a Google-like search engine that none of us has used. We're not in China. It's almost entirely a Chinese company. And if it's a public company, where would you expect it to be traded? Shanghai or Hong Kong? It's actually listed and traded on the NASDAQ. Your first reaction is, why? Because the Chinese government actually has restrictions on foreigners investing in some sectors which they view as sensitive. Technology is one. So if you're a technology company in China and you listed in China as a company, then it becomes difficult to attract foreign capital because of these restrictions, which keeps your market cap down. So they've created essentially a way of getting around this, but they have to jump through some hoops to do it. In fact, when you buy shares in Baidu or Alibaba, you're not actually buying shares in the Chinese company. You're buying shares in a shell company in the Cayman Islands that owns absolutely nothing. Think about that. But it has an operating agreement with the Chinese company where essentially they can lay claim to all of the revenues and profits. So basically, using a shell company that owns a Chinese company. And because you're buying shares in the shell company in the Cayman Islands, technically, you're getting around the rule. But for as long as variable interest entities have existed, there's been this question of, is it really a legal structure? And for the longest time, you know what the defense was? These are such big companies, the Chinese government is not going to look at a goose that lays golden eggs, get rid of it or kill it. And this is again something that in the last year, the Chinese government has started looking at, saying, maybe these variable interest entities are not quite legal. Can you imagine? $200 billion company, you wake up tomorrow and you own shares in a Cayman Island shell company that owns absolutely nothing. It's terrifying in some sense if you think about it as an investor in Alibaba or Baidu. But if you're investing in Baidu on some delusion that you can actually change the way the company is run, let it go. The company you're going to control is in the Cayman Islands that does absolutely nothing. The operating company in China is beyond your reach. Alibaba, even before it got into trouble, was run by 19 people who were picked by Jack Ma. And of course, he has his own interests. Whatever you think about Jack Ma, but you had no control on who ran the company. So what I'd like you to do is take a look at your top 17 shareholders and start at least to make some judgments. You're not going to feel certain. You never feel, but you're getting a sense of where does the power in this company lie. One final holding page, I went back and looked at Disney in 2009. Remember I showed you the 2003 page? So think like a shareholder in Disney. You look at this page. What do you notice has changed the most? Steve Paul Jobs. How the heck did Steve Jobs become Disney's biggest shareholder? Remember Disney bought Pixar, it paid in shares. Overnight, Steve Jobs has become the largest shareholder in Disney. You think, so what? As a shareholder in the company, I said in 2003, my stomach dropped when I looked at the top 17 lists. I look at this list. Do I feel a little better or a little worse? What do I want the board of directors to do? To kind of challenge incumbent managers, right? The big problem in the entertainment business, especially for a company with as illustrious and longer tradition as Disney is, they don't want to change. Do you feel a little better that Steve Jobs is sitting in the room now? I mean, Steve Jobs was never a get along, go along kind of guy, right? So if Bob Iger got up and said something stupid, my guess is Steve Jobs said that is really stupid. He doesn't think like a director. He doesn't even think like a manager. I don't even know what he thinks like, but it's nice having him in the room. Remember that that's what you are hoping for as a shareholder. Somebody in the room, I'm not talking Hamilton, I want somebody in the room though, who will challenge managers on the way they do things. In fact, I'm going to close today's session with who that somebody in the room might be for your company. Sometimes you look at the top 17 shareholders, you might see Trian, T-R-I-A-N. You know what Trian, who's behind Trian? That's Carl Icahn's group. Or you might see the group. So I'll send you the list of names behind activist investors. If you see that name on the list or that group on the list, it should make you feel a little better, not because Carl Icahn is thinking about your interests. Let's be quite clear. Carl Icahn is not the deepest thinker in the world. Have you noticed what his usual tactic is with the company? He comes to a company and says, you have too much cash, give me the cash. That's pretty much it, right? Every company Carl Icahn targets. But he targets companies which shouldn't be holding the cash that have taken terrible projects. I don't want to go to dinner with Carl Icahn. I'm afraid he'd eat me. But I want Carl Icahn in the group shaking up the process. That's what you're looking for. Shaking up the process doesn't mean that you control the process, but you challenge management. US has a lot of activist investors. And people don't like them for the most part because they ascribe the worst of motives to them. And let's face it, they want to make money. They're going to do things that make them more money. But you know what activists invest? I call them the laxatives for markets. Just think of what happens when you don't have laxatives. You get constipated. Markets with no activist investors get incredibly constipated. Nothing changes. Europe is very proud about the fact that it doesn't have as many activists. It used to be proud of the fact there were no activists invest in Europe. That's changed. But be very careful when you wish for it. If you don't have people pushing back against power, you're going to get a lot of companies stuck in the status quo with your capital, and you can't get to it. They're doing bad things, but you can't stop them. So the next time you read a news story about how terrible Bill Ackman was for making billions during COVID, or how Carl Icahn has bad habits and does something on the side, be glad that you have the Carl Icahns and the Bill Ackmans of the world around. Because without them, incumbent managers would have nobody to answer. It's basically other people's money. There's nothing you can do about it. So you and I will never be in a position to challenge these managers. You want somebody in there who's going to be able to do it. So that's going to be a task before Wednesday, is see if you can print off the top 17. If you can get to a Bloomberg, great. If not, you can go to Yahoo Finance. There's top 17 are there. Even non-US companies, you should be able to get this information. With the Bloomberg, you can get it for any company anywhere in the world. The reliability you can question. But take a look at who owns shares in the company, because that's the first step in really doing a corporate financial analysis. I'll see you on Wednesday.
I have to make. I'm taking.